Swayam Prabha. Digital India. Educated India.
Okay, welcome to this session on commodity derivatives and risk management, and we will be continuing with our discussion on carbon derivatives. And if you recall, in the last session we were discussing about Kyoto Protocol. We also discussed about United Nations Framework Convention on Climate Change, that is UNFCCC, and how based on the UNFCCC guidelines or regulations, companies can earn three different types of carbon credits. That is your AAU, that is assigned amount units as per the cap and trade program, and CERs, that is your certified emission reduction units as per the clean development mechanism, and ERUs, emission reduction units, as per the joint implementation program. So if you can see, this is the three different types of carbon credits which a particular company can own or trade. That is AAU, assigned amount units, which comes from the cap and trade program, certified emission reduction units which come from the clean development mechanism, and emission reduction units which come from the joint implementation mechanism. Now, subsequent to Kyoto Protocol, the Kyoto Protocol, this UNFCCC met at Doha on Doha Qatar on 8th December 2012, and a new amendment was adopted. And what was the new amendment? The new amendment intended to reduce the greenhouse gas emission by 18% below the 1990 level in the during 8 years period starting from 2013 to 2020. If you recall, the phase 2 of the Kyoto Protocol, which intended to reduce the total greenhouse gas emission by 5% during 2005 to during 2008 to 2012. So this particular Doha round is an extension of that agreement, in which all member countries want together jointly they will reduce the greenhouse gas emission by 18% below 1990, and this will be achieved over a 8-year period from 2013 to 2020. Otherwise, most of the other parts of the Doha agreement would be are same as far as this particular commodity derivative commodity derivative discussion is concerned, though there are some other policy changes and all, but that we are not going to focus on this discussion. Now, subsequent to the Kyoto Protocol agreement, European Union Climate Change Program started a European Union emission trading system. Let me repeat, to bolster the activity or to promote the activities of Kyoto Protocol, European member nations created or started a trading system which was known as European Union Emission Trading System, or EU ETS, and this EU ETS started in the year 2005, and with the very clear-cut objective of facilitate trading trading of carbon credits among the industrial operators and countries within the European Union. So, which kind of a carbon credits could be traded at this EU ETS? It is these carbon credits are known as European Union allowances or EUAs, which are equivalent to AAUs. There is nothing, there is no difference between AAUs or EUAs, they are the same. So, this EUAs were traded at EU ETS. Besides this European Union allowances, certified emission reduction and emission reduction unit were also traded at EU ETS. Now, this particular this http www.eex.com, this website will take you to the EU ETS trading system. So, you can go into this particular website and see what are the different kinds of contracts and what trading happens. Also, another exchange which is known as the ICE.com. This particular exchange lists the futures and options contract on different types of carbon derivatives. So, these two exchanges are world famous for offering derivative contracts on carbon credits. Now, let us go to little bit more on understanding of EU ETS program, EU ETS trading system. Now, European Union allowance were not freely given like AAUs. If you recall, AAUs were distributed to industrial operators by a member nation. Let us say a member nation is entitled to emit X units of AAUs, and this AAUs, this X unit is distributed to the industrial operators based on certain guideline, and these industrial operators are free to emit whatever has been allocated to them. If they emit more than that, they have to go to the exchange to buy carbon credits to the extent of extra emission they have generated. Now, this European Union trading system as part of the EU ETS, what they decided is that this all EUAs are not to be given free, or this assigned units will not be given free, and a part of the assigned units will be given free and a part has to be auctioned as part of the EU ETS system. So, the auction will happen in the EU ETS system. So, now let us take a example to understand what is this auction and how this auction happens. Let us say, so this particular let us say this, let us first understand the spot trading of the carbon credits. Suppose a country is free to emit 25 units of carbon dioxide equivalent. So, as per the UNFCCC convention, a country is free to emit 25 million units of carbon dioxide. So, when we are talking about country, it is nothing called a country. The industrial operators or companies operating in that countries are free to emit this 25 million units. Now, let us say this 25 million units has to be distributed freely among the 4 industrial operators. Now, A will get 9 million, B will get 6 million, C gets 3 million and D gets 7 million. Now, how this A, B, C, D, how these different amounts will be distributed? This will be distributed based on the past operating history of of these 4 industrial operator. Let's say A is a thermal power plant, and traditionally thermal power plants have emitted more greenhouse gases. So the nature of operation is that they are going to emit more greenhouse gases. So more more of AAUs are assigned to or allocated to this industrial operator A. So depending upon the nature of operation, a country decides to allocate 9, 6 and 3, 7 million respectively among A, B, C, D. Now what is the actual carbon dioxide emitted, like by the end of the year? Let's say A emitted 12 million, B emitted 2 million, and C emitted 4 million, and D emitted 4 million units. Now what is going to be the surplus? The surplus is going to be, so the surplus is negative 3 million. That means this company or this operator was supposed to emit only up to 9 million, but it has gone up to more than that, so 12 million. So it has a deficit of 3 million. Similarly, party B or industrial operator B has 4 million surplus, C has 1 million deficit, and D has 3 million surplus. Now what will happen? B and D are going to be the sellers of the carbon dioxide or carbon credits. They are going to be the seller of carbon credits, and A and C are going to be buyers of the carbon credit. They are the deficit they are the deficit industrial operators. So they have to go to a commodity exchange and they can buy these units, 3 million and 1 million, 4 million units, and these parties, these two B and C will be the sellers, and B and D are going to be the seller, and A or C are going to be the buyers, and they will go to the exchange platform and buy and sell the commodity carbon credits. This is a example of when the carbon credits is given absolutely freely, and depending upon the actual emission, these industrial operators will go to the exchange platform and buy the deficit, this carbon credit if they have generated more greenhouse gas emission, and those who are emitted less greenhouse gas, they will be selling these assigned units. Now let's go to to understand how EU ETS undertakes a auction. So what exactly is the auction of carbon credit? Let's say this country decides not to distribute the complete 25 million carbon credits free of cost. It only distributes, it is willing to distribute only 80 units as 80% of 25 million free of cost, and rest 20%, that is 5 million, will be auctioned off. So how exactly this will happen? Let's understand. So as part of the free distribution, A will get, let's say, 8, B will get 4, C will get 2, and D will get 6 million. Sum total of it is 20 million. Now the remaining 5 million will be auctioned off in the exchange platform. So I'm sure all of you must be knowing how companies auction their shares. When a company comes out with a IPO, initial public offer, they solicit bid from different buyers, and depending upon whoever is the whichever buyer or the buyer who has given a highest bid, those buyers are allocated shares. Exactly the same procedure is undertaken at EU ETS. So these 5 million AAUs or EUs will be available for buying, and these 4 industrial operators will be bidding for these 5 million carbon credits. So depending upon whichever party has bidded highest amount, accordingly allocation will be done. Now let's go to, let's say as part of the auction process, B got allocation of 2 units, C got allocation of 2 units, 2 million units, 2 million unit, 2 million unit, and D got allocation of 1 million unit, and A did not get any allocation because A probably had quoted a very low price, so it did not get a allocation. So going by that, what is the total allocated unit? Allocated unit is 8 unit for A, and for B 4 unit freely given, 4 million units freely given, 2 million units was procured or bought by the company, so on and so forth. And what is the actual emission? Total emission is going to be 10 and 7, 3 and 12. So going by that, what is going to be the surplus or deficit? It is going to be -2, that is deficit. The company owns or permitted to emit 8 million, but actually it has emitted 10 million, so it has a deficit of 2 million. Similarly, party B or industrial operator B is -1, industrial operator C is +1, and D is -5. So obviously C is going to be the seller of the carbon credits, 1 million unit, and A, B, D are going to be buyer of the carbon credit. And if this kind of a situation happens, when you have more amount to be bought more than the amount to be sold, it will give rise to the spot price of these carbon credits are going to increase. Now let's focus on this is the I have taken a EEX website, how auction is done. A announcement by the EEX website says that in today's primary market auction, which was held on 24th June 2016 11 am on behalf of the Germany government, 3.495 million of European allowances was auctioned off on the EEX spot market at a price of 4.96 euro per unit of EUA. So this 3.495 million EUAs were auctioned off, and people who bidded for it on an average, they may have bidded at different price, but they have paid to buy they have paid 4.96 euro to buy 1 unit of European Union allowance. Now let's quickly discuss discuss a little bit about USA and Kyoto Protocol and greenhouse gas emission reduction initiative. This particular table shows what has been the greenhouse gas emission in terms of units during 1970 and 2012. This data I have calculated from worldbank.org. In fact, this detail I have discussed in the previous class. So you have, if you see this one, if you see Brazil emitted 1.26 million in 1970, and it has gone up to 2.989 million in 2012. And China is a remarkable, remarkable growth in terms of greenhouse gas emission. Almost 11 times it has gone up. India also has gone up significantly, and if you see USA from 5.4 million to it has come down to 4.64 million during 1970 to 2012. However, one interesting aspect is that USA is not part of a Kyoto protocol signatory. USA did not sign the Kyoto protocol. However, many support groups and citizen advocacy groups and academic institutes have undertaken many initiatives which has resulted in many programs being undertaken in USA for reducing greenhouse gas emission. So some of the interesting or some of the important initiatives I have listed. So which are these? US Conference Mayors Climate Protection Agreement, Regional Greenhouse Gas Initiative, and this is Western climate initiatives, US Environment Protection Agency acid rain program, and California Climate Action Registry. There are many more initiatives. This is just a sample examples of what are the different initiatives taken by different organizations, different bodies in USA to reduce the greenhouse gas emission. And at this juncture, I am just going to discuss little bit on this acid rain program. US Environment Protection Agency, US EPA, started a acid rain program. So what exactly this acid rain program? It requires coal-based electricity utilities to reduce their sulfur dioxide and nitrous oxide emission. So it is basically a cap and trade program. So all these coal-based electricity utilities will be are permitted to emit some level of sulfur oxide and nitrous oxide, and beyond that, if they emit this sulfur oxide and nitrous oxide beyond that amount, they have to go to the exchange platform and buy the excess emission. It's exactly like a cap and trade program. And why this only coal based utility, electric utility has been identified. In fact, if you know that 1/3 of the greenhouse gas emission comes from coal fired electricity generation. So this is a major contributor towards the greenhouse gas emission all over the world. Now with this, we'll discuss a little bit on spot future price relationship between carbon credits. And if you recall, any derivative can be modeled using your cost of carry model. And in this, as you can see in this formula mentioned, ST is your spot price of the the underlying. So in this case, it is going to be the carbon credit. R is your cost of capital. Delta or Y in the previous session, sometime in the previous session we have discussed, it is nothing but a convenience yield, and T is your time to maturity. And if delta is more than R, then the commodity is in short supply and the market exhibits backwardation. So without any supply restriction, or if the underlying commodity is available in abundant manner, then the market will exhibit a contango. That means futures price is going to be more than the spot price, and far month future price is going to be more than the near month futures price. And when we price the carbon futures contract, we do not have to adjust or accommodate the storage cost, because there is no cost associated with storing carbon credits. So the formula for calculation of the carbon derivative is this. There is no storage cost, and there is also delta is also 0, because carbon credits there are abundant amount of carbon credit available for trading. In fact, supply is more than the demand. So futures market is always contango in nature when the carbon credits are the underlying. Now let's quickly take you through the spot and futures contract specification for this carbon credits. Okay. Please focus on this particular . If you see, this is the contract specification for European Union allowances futures product, and what is the underlying, that is EU allowances, and which is permitted, which is equivalent to emit 1 ton of carbon dioxide equivalent. And what is the delivery method? Please see this one. Or delivery period, you can have monthly futures, you can have quarterly futures, and you can have yearly futures. And as of today, somebody can enter into futures contract for a contract going up to 2020, December 2020. What is the minimum lot size? That is 1000 units of European Union allowance. And how the transfer can happen. The transfer will happen through a escrow account. So I am not going into this detail. It is mostly like the way the transaction happens currently for your share buying and selling. So from your demat account, share gets transferred. If you are selling, shares gets transferred to the buyer's demat account. Exactly similar procedure will be followed. Now, when we are talking about the spot and futures price, let's quickly discuss what is going to be what are the factors which influence the spot and futures price. And let's first discuss what are the factors which influence your spot price. In fact, one of the very important determinant of the spot price is the amount of allowance unit available for sale. If a higher limit is given to us, given to an industrial operator, and that means that industrial operator will have a more amount of allowance units available for sale. So the supply will be higher. And now let's go to the second factor which will be influencing the supply, that is new projects under CDM and JI mechanism, joint implementation mechanism. So if more number of new projects are coming, so you will have more number of CERs and ERUs available for trading. And very interestingly, the price of natural gas and coal also is a significant contributor of carbon credit price. We will come to that discussion little later. Also, another thing, demand from World Bank is also another major contributor of the carbon price. So World Bank has a unit called Carbon Finance Unit, which is a major purchaser of CERs and ERUs. So this Carbon Finance Unit buys CERs and ERUs, and by buying these CERs and ERUs, the demand increases, and thus it influences the spot price. And if you can see this as mentioned in this particular PPT, from 2000 onwards, World Bank has bought around 187 million tons of carbon dioxide equivalent. So the demand from World Bank influences the spot price considerably. Now let's focus on how the price of natural gas and coal influences the carbon spot price. We know that companies can either use coal or it can use natural gas to generate electricity. So when electricity or higher gas based electricity generation leads to lower GHG emission and more availabilities of allowance units and less price for carbon. So whenever companies start using gas for generating electricity, natural gas for generating electricity, they emit less greenhouse gas emission. So when they emit less greenhouse gas emission, their available of assigned unit becomes more, and this influences supply of carbon credit increases, and this influences the spot price. In fact, some researchers have undertaken a study. When the gas price goes down and electricity generators start using gas, then the carbon credit price drops, and as you can see, this report indicates that a fall in gas price from $6 to $2 reduces the carbon dioxide emission prices by 10%. Now, with respect to this price comparison between coal and natural gas, we have two concepts called dark spread and spark spread. So what exactly is a dark spread? Price of electricity minus the price of coal into the hit rate of the coal. And what is the spark spread? Spark spread is price of electricity minus price of gas into hit rate of gas. From these two spread, when we are subtracting the price of carbon dioxide and emission intensity of a particular plant, what we get is a clean dark spread and clean spark spread. So when clean spark spread is greater than the clean dark spread, then companies will be using gas to generate electricity. Let me repeat, when the clean spark spread is more than the clean dark spread, companies will be using natural gas to generate electricity. In fact, when we equate these two equations, clean dark spread equation and clean dark spread and spark spread equation, what we get is something called a implied switching cost of implied switching cost. So what exactly is implied switching cost or price? Is the cost associated with switching from coal to gas. See, coal is a cheaper source of generating electricity. So naturally, companies will be interested to use coal to generate electricity. And when they use coal, they emit more GHG and they have to buy carbon credit. So if carbon credit price is more, then they will be discouraged to use coal, because if they use coal, they have to end up they may be saving on gas, they may be saving on cheaper coal, but they may end up paying a higher cost for buying carbon credits. So if carbon price traded in the market is higher than the implied switching price, then it will be beneficial for the power producer to switch to gas. So many power producers calculate this implied switching price and accordingly take a decision. Now with this we will end up our discussion. So just a key questions, that is, what are the different types of carbon credits, and how these carbon credits are generated, and what is the difference between auction of carbon credit and spot trading, and what factors influence the spot and futures price of carbon credits, and how clean, dark and spark spread is calculated, and how price of carbon credit influences the choice for coal versus natural gas. With this, we will be winding up our discussion on carbon credits, and as usual, I am ending this session and looking forward to interacting with you in the next session. Thanking all of you.